Now, in industry analysis, we understand that say we talk about the different industries like this: banking industry, pharma industry, FMCG, fast moving consumer goods industry, automobile industry, let us say IT industry. So we are talking about that say in industry specific. As I told you that say if at all I am considering to make investment in, let us say, Apple stock, then in that case, first of all, so the making analysis of the US economy, and then say going for the specific that say the IT sector to which say that Apple stock is belonging to, or electronic appliances say to which that IT stock, that is say the Apple stock, belongs to. So we are going to focus on that area. When an economic survey, sorry, when an economy grows, it is very unlikely that all industries in the economy would grow at the same rate. So it says that say the growth rate of the economy may be 10 percentage. However, all the industries may not have grown at the same rate of 10 percentage. Few industries would have given more contribution than 10 percentage. Few would have given less than 10 percentage. And of course, we are interested to have investment in an industry which is likely to grow at a higher rate. So it is necessary to examine the industry specific factors in addition to economic wide factors. First of all, an assessment has to be made regarding all the conditions, factors relating to the demand of the particular product, cost structure of the of the industry, and other economic and the government constraint on the same. Since the basic profitability of any company depends upon the economic prospects of the industry to which it belongs to, an appraisal of the particular industry's prospect is essential. Factors affecting the economic analysis, sorry, industry analysis. So over here again we are going to understand that the factors, techniques. So this point is also divided into two parts, which are the factors, and the second is that which are the techniques that will be used in the factors of the industry analysis. Like manufacturing sector, textile sector is what we understand is like the kind of industry. Product life cycle, demand and supply gap, barriers to the entry, government attitude, state of the competition in the industry, cost condition and profitability, technology and research. So these are the different factors which are going to have the impact on the industry analysis. So let us keep in our mind that say we are going to do industry analysis for automobile sector. Then in that case, what we are going to do a kind of industry analysis. The following factors may particularly be kept in mind while assessing the factors relating to an industry. Product life cycle. An industry usually exhibit high profitability in the initial and the growth stage, medium but steady profitability in the maturity stage, sharp decline in the profitability in the last stage of the growth. So it says like this. So initially it will be having high profitability, in maturity it will be having stability, and later on it will be the lowest. So you are required to see that say uh, the industry is in which stage. If it is in the initial stage or it is like in the growing stage, it is good. Otherwise, do not make investment in that industry. In short, this is the way we have to draw a conclusion. Demand and supply gap. Demand of that products manufactured by that industry and the supply. If at all the demand is more, then in that case, these companies are likely to earn more. If the demand is less, then in that case, these companies are likely to earn less. That is a simple logic that we have. Demand is more, then in that case they can quote more prices. If at all the supply is more, then they have to quote less price. Excess supply reduces profitability of the industry because of the decline in the unit price realization, while insufficient supply tends to improve the profitability because of the higher unit price realization. Barriers to the entry. Barriers to the entry means, like, suppose a company wants to enter into the insurance sector. Is it easy for a company to enter into the insurance sector? The answer is absolutely no. For that, say number of licenses are required, the huge capital is required. Only that say you can enter into that industry. So, what is the kind of, say, the requirements that say you have to enter into that industry is also going to make a difference. Any industry with high profitability would attract fresh investment. The potential entrants to the industry, however, face different types of the barriers to the entry. Some of these barriers are intent to the product and technology of the production, while others barriers are created by existing firms in the industry. Means the competition is such that say for anybody it is very difficult to enter into the market. What kind of incentive that the government gives? Of course, if at all you want to establish a company, say which is going to manufacture the products, say which are like environmental, that is say the friendly, then in that case definitely the government is going to promote you. If at all you are going to say do some businesses, say which may not be socially it is very much acceptable, or you are going to enter into some business of like the tobacco or wine, something like that, then in that case the government is not very much happy to give any incentive to you. You will not be provided with any subsidy in that case. You will not be provided with any tax exemption. The attitude of the government towards industry is a crucial determinant of its prospects. So government attitude is like positive, then as an investor you will be able to earn more, and vice versa. If government is going to have the huge taxation, number of restrictions, then in that case as an investor there are like less likely chances for you to get the return. State of the competition in the industry. The factors to be noted are the firms with the leadership capabilities and the nature of the competition among them in the foreign and the domestic market. Types of the product manufactured, namely homogeneous or highly differentiated. Demand prospects through classifications, namely customer wise or area wise. Changes in the demand pattern in the long term, immediate, short term. Type of the industry the firm is placed. Growth, cyclical, defensive, or decline. So, what kind of, say, the stage of the competition that the industry has? Cost conditions and the profitability. The price of the share depends upon the return, which in turn depends upon the profitability. Profitability depends upon the state of the competition in the industry. Cost control measures adopted by the unit and the growth in the demand for its products. So, the factors to be considered. So basically, the price of the security depends upon the profit of the company. Profit of the company depends upon the state of the competition in the industry, and so the cost control adopted by the units. So the factors considered are cost allocation among the various heads, raw material, labor, overhead, and their controllability. Overhead cost for some may be higher while others for labor may be. Labor cost, which depends upon the wage level and the productivity, needs close scrutiny. Price of the product, production capacity in terms of the installation, idle and operating. Level of the capital expenditure required for the maintenance, increase in the productive efficiency. Investors are required to make a thorough analysis of the profitability. This is carried out by the study of certain ratios such as GP ratio, operating profit ratio, return on equity, return on capital on total profit, etc. So basically we understand that so the cost condition and the profitability in that, uh, we understand that say we are required to make a detailed analysis. For example, if at all we talk about the pharma sector, then pharma sector is having a number of kinds of restrictions with respect to the price at which they can sell the product. We understand that say, there may be certain industries say, which rely for the raw material. Let us say that that is say it is importing its majority of the raw material say from outside India. Then in that case, say from which country you are importing? Is it a country which is having say the good relationship with India? Suppose you are importing from Japan, then in that case it is good. You will not be having any issue. But if at all you are importing the raw material which is from China, then in that case there is a threat that say India-China relationship is not so smooth. Then in that case, say there will be a kind of restriction from the government for the purpose of import, and at the same time say there can be such sentimental feeling because of which say you will not be like encouraged or you will not be liked by the customers say to buy the product, and all these things are going to have the impact on the profitability and return to the company. This is what we understand. Technology and research, they play a vital role in the growth and the survival of a particular industry. Technology is subject to change very fast, leading to obsolescence. Industries which update themselves have competitive advantage over others in terms of the quality, price, etc. Things may be probed in this are nature and the type of the technology used, expected changes in the technology for the new products leading to increase in the sales, relationship of the capital expenditure sales over the time. More capital expenditure means increase in the sales. Money spent on the R&D, whether this amount relates to the redundancy or not. Assessment of the industry in terms of the sales, profitability in short, immediate and long term. Friends, we can say something like this, that before 1991, uh, the Indian market was not open except for like the for foreign companies. So before 1991, the situation was like this. Let's say for that is to for an Indian that is say the consumer, say he had very limited number of choices. If at all we take example of like let us say a car, then in that case say they had that is a limited number of options like Ambassador, Fiat, Maruti, something like you can count with fingers. So that is what so the kind of limited options that so that is consumers had. But after 1991, Mr. Manmohan Singh and Mr. PV Narasimha Rao, they had opened the Indian market say for the foreign investors, for foreign companies especially. And because of that, say now it is possible for us say to access say foreign products very easily. Because of which what happens that say we understand that say even the Indian companies say made a good research and they also improved say their products. So this will be having say the kind of say the very huge impact so on the profitability or the return to the investor. That is what say we understand over here. Earlier we can say that say if at all you invent a product, then in that case you may be able to do business with that product, let us say over 10 years. But that is not the case now. You invent a product, it will be having say very limited life, say over the let us say 2 to 3 years, and then you're required to do updation in that product. You're required to come with certain innovative or some additional ideas with respect to that product. That is what say they mention over here. So the factors affecting the industry analysis is one, product life cycle, initial growth, maturity, something like that. Demand supply gap. Demand is more, then there are good chances for you to have good return, and vice versa. Barriers to the entry, maybe through the licenses or maybe the competition of that say the industry. That is, if at all you want to establish a company, say which provides say the mobile network. So you want to enter into that line of the business. But that's the line of the business may be so competitive now that it is not possible for anybody to enter into the market unless you are ready to bear a loss for a longer period of time. Government attitude for you, that is for that industry, state of the competition in that industry, within that cost control and the profitability, that is availability of the raw material, everything, technology and research. Next is techniques used in industry analysis. Regression, that is we understand that's the r square, something like that. Input output analysis, the techniques used for analyzing the industry wide factors are: investors diagnosis the factors affecting the demand for the output of the industry through product demand analysis. Factors such as GNP. So when the GNP increases at this rate, what will be the demand for this product, for this industry? Disposable income, per capita consumption. Okay, per capita consumption. That is overall what is the consumption and per capita consumption. Income, price elasticity of demand. That is again the economic concept which says that say what will be the percentage change in the demand for every 1% change in the price. Identify factors affecting the demand, statistical technique like regression analysis and correlation are used. That is R square. Input output analysis. It reflects flow of the goods and services through the economy. Intermediate steps in the production process as goods proceeds from raw material stage through the final consumption. This is carried out to detect the changing in the pattern or the trend indicating the growth or the decline in the industry. Uh, these are the techniques which are used. We do not have any numerical as far as these techniques are concerned. We just have to do a kind of the theoretical studies. So after understanding the economy, industry, now we are talking about the particular company, because we understand that say the economy is growing at the rate of 10 percentage, but all industries are not growing at the rate of 10 percentage. The different industries are growing at the different rates. The industry which is likely to grow at the highest rate, say that is what we have forecasted, so we are going to make investment in that, say the industry. Now within that industry, once again the same kind of situation will be there. The companies which belong to that industry may not be able to have the same growth, may not be able to give the same return. So you try to pick up a company which is likely to give you the maximum return. Economic and the industry framework provides the investor with the proper background against which the shares of the particular company are purchased. This requires careful examination of the company's quantitative and qualitative fundamentals. Okay, so we are going to understand net worth or the book value of the company in which you are going to make investment, from where they source the funds and where they use the funds. Cross sectorial and time series analysis. So this is something that's the statistics that you have to apply. Size and the ranking. So in the industry, let us say that there are 10 companies. So in with respect to its peers, where does it rank? Is it like the third largest company in terms of the sales? It is the sixth largest company in terms of the net worth, something like that. What kind of growth record? Financial analysis, that is ratio analysis and everything. Competitive advantage. So what is the unique feature that say that company has, and with that it is able to do business say in that industry. Quality of the management, of course the top management of the company. Corporate governance, that is a kind of like the soft aspect. Regulation, so is it meeting with the laws or not? Recently, friends, you must have observed that so the Google, Facebook, so they have been like highly penalized with respect to violating the law with respect to the that is say they are violating the cyber laws in which say they track the invest that is say they track the uh, that is the internet users in terms of their activities, location and the labor management relationship, pattern of the existing stock holding. So had the promoters share, that shows that so the promoters are like they are keenly involved in the business. So you will also have a kind of inclination to make investment. If at all the promoters share is very less, so they would not be interested if at all the company is going down. Marketability, that is liquidity of the shares. So these are the 13 points which they have mentioned in terms of the company analysis. Next is what they have included over here is techniques used in the company analysis. Correlation and regression analysis are R square once again. Trend analysis. Decision tree analysis. Decision tree is basically say a kind of operational research technique that you can apply. Friends, usually in 4 marks of the question, you are not expected to write all the 13 points. At least you have to write 4 points properly with like something within that say the point which is relevant, and at the same time what you can do friends that say you may mention the other points. So do not have a burden that you have to remember everything, but try to remember maximum, at least in terms of the head points, and you will be able to have some logical way. Okay, like if at all we do the company analysis, then in that case we look about the promoters, we look about the what is the ranking of that company in terms of the industry, then what kind of the record that it has, is there any pending litigation, all these things that say you usually always say observe. So the same thing is what we understand is required to be done. Net worth and the book value. Net worth is sum of the equity share capital, preferential capital and free reserves less intangible assets in any carry forward losses. The total net worth divided by the number of shares is much talked about the book value of the share. Means we understand that say we find a kind of fundamental price. Of course, that is supposed to be compared with the actual price for the purpose of decision making. This is one of the method. Though the book value is often seen as an indication of the intrinsic worth of the share, this may not be so for the two major reasons. Market price of the share reflects its future earning potential of the firm, which may have no relationship with the value of the assets. So it says that whatever this price that say you compute may be very much different from the market price which is prevailing in the market. Why? Because we understand that say the net worth is indicating then in past whatever you have earned based on that say where you have reached, and the current market price is indicating so the present value of your future earning. So a company which had a like the glorious past, that does not give an assurance that say in future also it will be having say the same growth or the same future earning. Second, the book value is based upon the historical cost of the assets of the firm, and these may be gross underestimates the cost of the replacement or the resale value of these assets. Means over here, we can say that say, there are two things that say, we are required to mention. We are required to explain like the net assets, and we are required to mention the limitations. We know that say, whatever the limitation is there in the accounts, the same limitations will be mentioned over here. Reliance company had purchased the land in Jamnagar, let us say that's in the year 1980. So today the value of that land may be 5 times or maybe even more than that. But still in the books of accounts of the Reliance company, it is at the book value only. The Reliance company had purchased the office in Mumbai. Let us say that's in the like the uh, in the heart of the city. It was purchased again like 30 years back. So the book value is very marginal and its market value is beyond imagination. Sources and the uses of the funds. In that way, we will always keep in mind that the proportion of the debt financing in the capital structure should be reasonable. In no case it should be high. If it is high, then in that case definitely it is considered to be a demerit. If it is low, then in that case definitely it is considered to be say a good point. But if it is say having high debt financing, then in no case it is supposed to be considered as a good company, because the high financial leverage will have an impact that say the company will go into the liquidation at any point of time if they are not able to make the payment of the financial charges. The identification of the sources, that is from where you get the funds. Uses means where you make investment, is known as the fund flow analysis. One of the major uses of the fund flow analysis is to find out whether the firm has used short-term sources to finance long-term investment. I do not know that say whether you recall or not. You have something like called working capital financing policy when you were studying at your second level. In that say you have a point that say the permanent current assets should be financed with the long-term funds and not short-term funds. So they speak something like that only. Such methods of the financing increases risk of the liquidity crunch for the company. So if after you use more of the short-term financing, then you may recall that say in that case the return will increase, but in that case the risk will also increase substantially. Such method of the financing risk, sorry, as long-term investments, because of the gestation period involved, may not generate enough surpluses in time to meet the short-term liabilities. So very good statement that they have provided. You cannot have the public deposits, you cannot have the bank overdraft for the purpose of construction of the factory. You are foolish if at all you do so. Why? Because that construction of the factory is going to give the return over like 10 years, 20 years, and with that, so you will be able to make the repayments. In comparison to that, listen carefully. In comparison to that, we understand that say if at all there is an export order that you are supposed to finance, then in that case you can go for the packing credit. Why? Because soon after you ship the goods, you are going to have the realization of the sale value of the goods, and so with that, so you will be able to make the repayment of the loan. Many a firm has come to a grief because of this mismatch. Grief means they will be stuck up and they will go into the liquidation in simple language between the maturity period of the sources and the uses of funds. Cross sectional and time series analysis. One of the main purpose of examining the financial statement is to compare the two firms, compare a firm against some benchmark figures for its industry. That is average. Means leverage. What is the average leverage and what this company is having leverage? Debt equity ratio, GP ratio, all those things that you study in ratio analysis, and to analyze the performance of the firm over the time. So over the time there is an increase in the financial leverage, there is a reduction in the GP ratio, return on equity. These things are required to be observed. The technique that are used to do such proper comparative analysis are common size statement. So common size statement is something that say you are aware. Suppose the sales of the company is 6 lakhs and the raw material consumption is 1,20,000. Let us say that the direct labor cost is 60,000. Then you do that, so the sales is 100, direct material cost is 20, direct labor cost is 10. So for every 100 rupees, let's say you reorganize everything. That is what we understand is a common size statement. And this is what say you do for last 3 years. So sales value is 100, that is replacing the actual sales value. In comparison to that, so you just see the raw material expenses. You see the direct labor expenses. So technically, The variable cost will be same over the year. The fixed expenses say will go up if at all the sales is falling down, and vice versa. Size and the ranking. Size in terms of in comparison to the industry where it belongs to, and the ranking is again in terms of the industry. A rough idea regarding the size and the ranking of the company within the economy in general and in the industry in particular would help the investment manager in assessing the risk associated within the company with the company. In this regard, the net capital employed, the net profit, return on investment, sales figure of the company under consideration may be compared with the similar data of other companies. Means peer group analysis. Friends, we have studied in the portfolio management a term called levered and unlevered. In that also the same concept was there. Of course, so it was not in terms of the comparison. It was only using that information in order to compute that. So what is the risk adjusted discounting rate in the same industry group. It may also be useful to assess the position of the company in terms of the technical know-how, means the research, development activity, and the price leadership. So these things are required to be compared. Growth record, growth in the sales, growth in the net income, growth in net capital employed, and the earning per share of the company in the past few years should be examined. The following three growth indicators may particularly look into: price earning ratio, that is PE ratio, percentage growth rate of the earning per annum, and percentage growth rate of the net block. So positive growth rate is a good sign and vice versa. The price earning ratio is an important indicator for the investment manager. It is MPS upon EPS, that is a price earning ratio. Suppose it is 10. It means that say for every 1 rupee of my earning, I pay 10 rupees. That is what the price earning ratio is. So if at all the industry price earning ratio is 25, and if at all I buy a stock which is having the price earning ratio of 15, then from an investor point of view, it is a good indicator. Recently, you might have heard that say the Adani Wilmar stock say had a price earning ratio of like 44 times. While in the industry, on an average, the price earning ratio is substantially more. Even the lowest price earning ratio was 46. So this is the way you can make a comparison of the industry price earning ratio with the price earning ratio of the company. Lower the price earning ratio is good for the investor. It shows the number of times the earning per share are covered by the market price. Theoretically, this ratio should be same for the two companies with the similar features. However, this is not so in practice due to many factors. Hence, a comparison of this ratio pertaining to different companies, investment manager can have an idea about the image of the company and can determine whether the share is underpriced or overpriced. Consider the following example. Simple example they have given. Face value is 100 and the market price is 150 and 250. Earning per share is same 25. So of course for the B company the price earning ratio is 10 times and for A it is only 6 times. So what they want to explain us, if at all everything is same, risk for the investor is same, both of them are belonging to the same industry, there are no changes, let us say that everything else is same, then of course from the investor point of view, better to buy company A stock. Why? Because say by paying 150 you can get 25. Otherwise for company B you have to pay 250 for earning 25. It is obvious that the purchaser of the company A's share pays 6 times its annual earning, while purchaser of the company B's share pay 10 times. If other factors, intrinsic value of the share, growth potential, etc., are quite similar, it is obvious that the shares of the company A are preferable. In practice, however, other factors are never similar in case of the two companies. So other factors are definitely going to be different. That is, they will have say certain like the differences. But suppose it is like that, then in that case, say you should purchase company A shares. The investment manager must try to ascertain why EPS in company B is comparatively low. Maybe some factors are not apparent. EPS calculation cannot be the sole basis of deciding about the investment. So definitely we understand that say there is not only one criteria based on which you can take a decision. There are number of criteria that say you have to combine, and based on that say you have to take a decision. Yet it is one of the most important factor on the basis of which the investment manager takes a decision to purchase the shares. This is because it relates to the market price of the share and the earning per share. The percentage growth rate of the net block shows how the company has been developing its capacity level. Obviously, a dynamic company will keep on expanding its capabilities and diversify its business. This will enable to enter into the new and the profitable lines to avoid the stagnation on the growth. Stagnation on the growth means the growth rate is at the same rate. In this context, an evaluation of the future growth prospects of the company should be carefully made. This requires an analysis of existing capabilities and their utilization, proposed expansion, diversification plan, and the nature of the company's technology. The existing capacity utilization level can be known from the quantitative information given in the published profit and loss accounts for the company. The plans of the company in terms of the expansion or diversification can be known from the director's report, the chairman's statement, and from the future capital commitment as shown by way of the notes to the balance sheet. So we understand that say in fundamental analysis, what kind of report that the director is say providing, what kind of say the notes to the balance sheet, that say you're required to carefully or get that is say the read uh, before you make investment. The nature of the technology of a company should be seen with reference to the technological development in the concerned field, the possibility of the product being superseded or possibility of the emergence of the more effective method of manufacturing. So these are the internal details of the company that say you have to read properly. Growth is a single most important factor in the company analysis for the purpose of investment management. A company may have a good record of the profit and the performance in the past, but if it does not have the growth potential, its shares cannot be rated high for the investment. So in past you had done great, but that does not have an assurance of doing great in the future. Financial analysis, that is a routine one. Nothing is great in that. Uh, Friends, I would like to tell you that from examination point of view, if at all you are able to mention all these things, then in that case your answers will be really considered to be a quality answer, because these are something which are very important. Giving this example of the price earning ratio, that is also something which is very simple in my opinion. Uh, Nothing is great in that. And friends, as far as these numericals are concerned, all these numericals are covered in the chapter of the analysis, I'm sorry, security valuation, in which we do number of valuation, and at the same time the corporate valuation, mergers and acquisitions. In that also the similar aspects are covered. An analysis of the financial statement for past few years would help the investment manager in understanding the financial solvency and liquidity, the efficiency with which the funds are used, profitability, operating efficiency, financial and the operating leverage of the company. Okay, financial leverage BFL, operating leverage BOL. For this purpose, certain fundamental ratios are to be calculated. From the investment point of view, the most important figures are EPS, price earning ratio. Okay, EPS is earning available to equity shareholders and so on. Yield, yield means return. Book value per share, intrinsic value per share. For that, so there is a detailed point once again. These five elements may be calculated for the past 10 years or so and compared with the similar ratios computed from the financial accounts of the other companies in the industry. So that is again it comes to the peer comparison. With the average ratios for the industry as a whole, the yield means return to the investor. Asset backing of the share are important consideration in a decision regarding whether the particular market price of the share is proper or not. Various other ratios are to measure profitability, operating efficiency, and the turnover efficiency of the company may also be calculated. The return on owner's investment, capital turnover ratio means the sales for every 1 rupee of the capital. Cost structure ratios, variable cost to sales, fixed cost to sales, something like that, may also be worked out. And of course, we know that so the expense ratios are less is good, profitability is high is good. To examine the financial solvency or the liquidity of the company, the investment manager may work out current ratio, liquidity ratio, debt equity ratio, capital employed ratio, capital gearing ratio, proprietary ratio. In that, so there is a huge list. These ratios will provide an overview of the company to the investment analysis. He can analyze its strengths and the weakness and see whether it is worth the risk for or not. Competitive advantage. Competitive advantage means that, say, how do you differentiate yourself? Um, are you able to differentiate by providing say, a better quality product? Um, Let us say that say, it is the Apple company which provides a product which like other companies are not able to provide, like this, or say you are able to compete with the price. Let us say that so the Geo is able to provide you say the price which is the best in the entire industry and you are able to get the market. So what is the key point because of which you will be able to grab the business? That is what say you are required to make an analysis, because the underlying factor is the business. By one or the other way, are you able to generate business? If yes, only in that case say you are able to like lead the market. And that is what say we have to always remember. It is any of the industry. Another business consideration for the investor is the competitive advantage. A company's long-term success is driven by largely by its abilities to maintain its competitive advantage. Powerful competitive advantages such as Apple's brand name, Samsung's domination of the mobile market create a shield around the business that allows the to keep the competitive at a distance. So, number of times, friends, you have observed that number of IT companies are not having such a profit in their business. Still, they have great valuation. Why? Because they have said the uh, number of the users say who use their platform is very large. So when you have the large number of the like the that is you have a good traffic on your platform, then in that case you have a potential to generate business out of it. That is the reason say uh, these platforms are able to uh, these platforms are able to get the value. Still at this point of time, they do not have such a good business. Like we understand that so the Paytm is say not able to charge anything for providing a service, wherein if at all I pay something to let us say a trader, then in that case the amount is collected from me and it is paid to that trader. So the Paytm is not able to charge either to me or to them, but still the Paytm is able to have say their valuation. Why? Because say they know that say when they have the number of like the users so on the Paytm platform, then one or the other product they will be able to sell to me, and with that say they will be able to get the business. Quality of the management.